Your market news now. Asian markets traded mixed, however, reversed losses to trade mostly higher as investors assessed China's industrial data. Overnight in the U.S., all three major indexes saw a sell-off after the latest home sales and consumer confidence reports stoked concern over the state of the U.S. economy, with the Dow Jones seeing its worst day since March. Meanwhile, locally, insurer Old Mutual posted an 8% fall in half-year profit. Like other insurers, Old Mutual benefited from higher interest rates, which provides for better returns on investments of premiums collected from clients. However, higher interest rates and inflation are squeezing consumers, making it difficult for insurers to generate new business and maintain premium collection. To give us perspective on the markets, we are joined by Sean Dendere, who is a senior sales trader at Tribe. Sean, thank you so much for your time. What's your assessment, or rather, how are you looking at market sentiment right now as we look at the backdrop in which, markets are trading?
All right, thank you for having me. So my assessment right now is that I do believe that the markets are in for a tough ride. I am seeing bearish sentiment. So I think you did mention that there has been a couple of rebounds in the US and in China. However, if we're looking at the month of September, all major indices and locally, they have been in the red. And that's just categorized by, the environment that we're operating in that is accustomed to the high inflation and high interest rates.
On that note then, let's expand on it. We've been talking about a higher for longer interest rate environment, or tighter for longer monetary policy. What does that mean for markets right now?
All right. So high for longer is that we're hearing that from the Federal Reserve that, they don't see themselves, decreasing interest rates in the near future. And that's not boding well for equities. Equities are down. And if you look at just, from a base level, companies will have to, push out more cash in order to what's the term I'm looking for, to pay their debts. So that is going to give a lot of strain on equities and companies in general, and then furthermore to the consumer.
All right, so we had Old Mutual releasing its results earlier this morning, increasing its dividend by just over a quarter. And this was as a result of the robust performance it saw. But at the same time, they are seeing pressure coming through from South Africa's economy. Were there key takeaways for you when you look at Old Mutual's numbers?
So my key takeaway, just I look at it overly from, the financial services companies that we have, such as your insurers and your big banks, that tend to do really well when it comes to an environment that is categorized by high interest rates, right? So that is really helping their balance sheets and, the income that they're getting. But in the long term, I don't think that is also quite sustainable, because we're seeing a lot of disinvestment from consumers with regards to taking out their savings in order to, to ease the pressures that they are suffering from, inflation and interest rates and the general economy at large.
You gave us a sense of, markets for the period of September, and we're about to wrap up September. Let's look back at the past 9 months. Were there any surprises for you, at least from a market's perspective? What stood out?
All right. So this year has really been interesting. I think from a market's perspective, the markets have really been resilient. If we're looking at how inflation has been quite high, Federal Reserves and locally the Reserve Bank has been on a hiking cycle, but we see that GDP has been quite stable. In South Africa, we've seen a bit of GDP growth there. We see that inflation tends to be cooling, so the interest rates and that environment is working out well. So that has been quite surprising, as the key underlying theme has been that we're potentially heading to a recession, which I'm still awaiting to see the recession that we've been potentially waiting for.
Okay, so on that note, on the recession, do you believe that this is a recession avoided or a recession delayed, or are you leaning on the delayed side of the camp?
I am definitely leaning on the delayed side of the camp, purely because I think, all the monetary policies have a lagged effect on the consumer and the economy at large. So eventually, I do believe that, or at least in my opinion, that we will see a recession maybe sometime next year.
So would that be the catalyst for the Fed to cut interest rates next year? Would it be a recession?
100%. I think that will be a key catalyst for the Fed to cut interest rates, because I do foresee the job market in the US loosening, and I also do foresee inflation potentially cooling a little bit faster than it is currently, but that's just due to consumer pressures.
Before I let you go, just quickly, a sector of the market that is attractive to you right now as we head towards 2024.
All right, so I wouldn't say a sector, but I would rather look at an asset class. So I'd be looking towards bonds and cash liquid type assets, just due to the fact that if you look at how treasury yields, at least in America, have been performing compared to equities. So I'll be looking at a lot of cash heavy type asset classes.
Sean, let's leave it there. Thank you so much for your time. That is Sean Dendere, who's a senior sales trader at Tribe. Looking at the markets right now, Rand trading at 19.13 to the dollar, and of course Brent at just over $93 a barrel. That is it for me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.